So this is part 4 in our series on how you can reduce your tax liability. We're continuing that conversation with Kanta and Naika. We're talking just overall about taxes and how we should be approaching our income tax and how it should be ideally working. All right, so let's jump into that interview with Kanta.
So you end up paying in tax if you haven't had enough tax deducted from you monthly. We've got to get this concept right in our heads, because the tax system has been built around you being taxed correctly monthly. Your payroll administrator or your accountant or whoever runs your monthly payroll should be deducting tax on the monthly income correctly. Then there are all the benefits, the fringe benefits we're talking about: travel allowance, car allowance, etc., retirement annuity, monthly deduction, which can be done based on the amount of retirement annuity that you contribute monthly, either that a monthly subscription or you can look at an annual deduction. But that calculation that gets done monthly should be to the cent absolutely correct. In this case, where it's done correctly, you should not be paying in any tax, provided everything else is equal. You haven't got income from any other sources. Your investment income is being swallowed up by the investment threshold I spoke about. So make sure that your monthly, if you don't want to end up paying tax at assessment, which is when you send in your tax return and you're receiving an assessment from SARS, make sure that your monthly tax is correct. It may pinch in the pocket because, yes, your disposable income monthly is not what you want it to be, and you always want to maximize your disposable income monthly. But the reality is, if you pay the right amount of tax monthly, you should not be paying at the end of the year. Now, lots of people say, oh, I always get back money from SARS and I always do this. Those are people who may be commission earners, who may be a very legitimate travel allowance, have a travel allowance as a fringe benefit, to a company car as a fringe benefit, and have been able to claim more than what was actually provided for when the travel allowance, the car allowance component was worked out. So SARS doesn't just give you back money miraculously. You've got to pay what sits in within the tax thresholds, and then legitimately, if you're able to claim against certain things. For instance, and this is a misnomer, and I'm going to walk away from what I had to say. People say to me, oh, I've got a car allowance and I've got a house allowance and a cell phone allowance and an allowance because I live out of home. Some of those things are valid, but not all of them. A cell phone allowance is not valid. It is fully taxable. So there's no such thing in the tax law. It's become precedent. People say, oh, I'm giving you a cell phone. It's a cell phone allowance. There's no cell phone allowance. You are receiving a benefit from the company by virtue of the fact that you work for that company. So you need to separate out what are allowances, what are benefits, what you receive by virtue of the fact that you've got to do a certain job in a certain way. So in order to carry out my job as a sales rep, I require a car. The company will provide that. That is a company car. I require a cell phone. The company will provide that. That is a fringe benefit given to me, which gets added into my cost to company in terms of total amount paid. I require safety boots because I work in a high risk environment, or I've got to walk into the factory and I can't afford to get injured. It is a fringe. It's a benefit received from the company as a result of the work that I do. So be very clear about, and the terms are very deceiving, right? Because fringe benefit, it's like you're getting a benefit, you're receiving a benefit, but there's still tax involved. I want to talk about subsistence allowance. This may interest the gentleman that asked the question earlier. Working in Durban and with the offices here in Joburg. So what is a subsistence allowance? If you travel for work regularly, it's part of your job. You're sales rep, or you're needing to visit sites across the country or out of the country, you're able to claim against an allowance that you receive. This allowance is called a subsistence allowance. There's specific rates for this allowance. It means that you put your head down at a place that you don't regularly put your head down. So you put your head down normally to sleep at your home, and that's where you lay your head at night. But if you had to go stay a night over in a bed and breakfast or somewhere out of town, particularly out of town, then you are entitled to a subsistence allowance for incidentals and medicals and things that may happen on the trip that are unforeseen. So when you receive this allowance, and this is one of the biggest issues with people being taxed on this allowance, is that they receive the money, they don't necessarily use it to buy the panados or the pay for the parking and the concierge and all of the other things that they're incurring on this trip. And they use the income as their own. They don't retain any slips to claim against that subsistence allowance, and you end up getting taxed on it at year end fully. So my suggestion is, as soon as you know you're traveling, that little folder thing I spoke about, I'll show you one just now. I've got one across the table. You have a little envelope in there for travel, and you stick all of these slips in there, and it can be everything from the toll to the coffees, to the parking, to the tips, to the dinners, to the panados at the pharmacy, plasters, and all of those sort of things, because those are incidentals, things that you are not incurring normally in your day-to-day business life, but you're incurring because you're out of where you would normally lay your head at night. So make sure that you also don't get paid more than the daily rate. If you're getting paid more than the daily rate that is published on SARS's website, and you'll see it's on in those little pocket books as well. If you get paid more than that, obviously you're going to be taxed, so you've got to be very clever about how you receive this money. And when you're getting paid, when you're traveling overseas, you're getting paid a rate at that country in dollars or pound sterling or whatever the case may be there. You've also got to make sure you maintain those slips and keep those slips to reduce your taxes at the end of the year. We've seen many people end up paying a lot of tax in because they simply couldn't prove the expenses for the subsistence allowance received. Sometimes you get this situation. You travel overseas, the company has paid for the airport transfer, the accommodation, the meals, and so your subsistence allowance is actually for the incidentals, and you don't have any incidentals. So rightly so, you should be taxed on that amount because you've got nothing to actually claim against it from a business perspective.
Here's more on how you can reduce your tax liability, and join us for part 5 with our last conversation piece on how you can reduce your tax liability in South Africa.